Welcome to this explainer. Look, if you're a young, first-time investor just stepping into the financial world, you are probably getting bombarded with endless advice. You've got hot crypto tips from influencers on one side, complex financial jargon on the other, and honestly, just a whole lot of noise. Well, today we're going to bypass all that hype. Instead, we're walking through a remarkably simple, highly effective framework for figuring out investment risk. We're not doing complicated finance theory here. It's about building a strategy that actually works for your real life. So let's dive right in. Okay, picture this. Imagine you finally saved up a pretty significant chunk of money. Let's just say it's exactly $10,000. You're sitting there looking at your bank app and you're wondering where on earth to put it. Should it go straight into stocks? What about bonds? Maybe an index fund? Or, maybe you should just keep it in cash. If you're like most beginners, the very first question that pops into your head is probably, which of these is going to give me the absolute highest return? It's a completely natural question, but here's the secret. It's actually the exact wrong place to start. Chasing the highest return right out of the gate? That's a massive trap. The very first thing you actually need to ask yourself is much simpler, but honestly, way more powerful. You need to ask, when exactly do I need this money back? This is absolutely crucial because the exact same investment, say a standard run-of-the-mill stock market index fund, well, it could be a brilliant choice for one person and a literal disaster for another. It all comes down to the clock. Act 1, redefining real investment risk. Let's rethink what risk actually is. Think about that definition for a second. When most of us beginners hear the word risk, we immediately just picture our money going up in smoke, losing everything, right? And yes, losing money is definitely part of it, but real investment risk, it's essentially about uncertainty. It's the simple fact that the value of an investment constantly bounces up and down. True risk actually happens when that wild market volatility violently collides with a strict, immovable deadline in your life. Act 2, the timeline reality check. Because honestly, time changes everything. Let's look at a really concrete example here. Say you invest that $10,000 in the stock market today. If your goal is short-term, like you're planning to use that cash for a house deposit next year, a market drop of 20 or 30% completely destroys your plan to buy a home. It's devastating. But what if your goal is long-term? If you're a young investor putting that exact same money away for a retirement that's, say, 30 years out, that exact same bad year in the market is literally just a small, uncomfortable bump on a really long road. Same investment, same market, completely different level of risk. Why? Because your deadline changed. This right here is a massive stumbling block for new investors. You might look at historical stock market returns and think, why in the world would I keep my house deposit in a boring bank account when I could be earning so much more in the market? Well, here is the harsh reality. The stock market does not care about your deadline. If the market falls 30% 6 months before you need to sign the papers for your new house, your dream is paused. The market might eventually recover, sure, but your deadline is going to arrive first. The real risk here is being forced to sell at a major loss simply because you need the cash right now. So for short-term money, boring is actually the smart choice. You absolutely must prioritize stability and access over maximum return. But what if your timeline is somewhere in the middle? Say 5 to 10 years out. You've got a bit more flexibility, but your deadline is still clearly visible on the horizon. This analogy brilliantly captures how you should treat medium-term money. It's exactly like landing an airplane. When you're far out at the beginning of the journey, you can fly high and fast, taking on more of that growth-oriented risk. But as you approach the runway, as your deadline gets closer and closer, you've got to gradually reduce your speed, lower your risk, and prepare for a safe landing. So mapping this out is absolutely crucial. For the next 1 to 3 years, you protect your money for stability. For 5 to 10 years out, you balance things and reduce speed. But if you zoom way out to 10, 20, or 30 plus years, that is when you enter the growth phase. This is where time becomes an incredibly powerful weapon, especially for young first-time investors. When you have decades ahead of you, you aren't dependent on what the market does next month or even next year. A long-term horizon gives you this massive margin for error. It lets the market and compounding do all the heavy lifting, allowing you to easily absorb and overcome short-term volatility. And this is exactly why long-term investing helps you avoid panic selling. You know deep down you have the time to just let the market recover. Act 3, the human element. Because behavior is everything. You can have all the time in the world and still completely derail your future if you make a terrible emotional decision during a major market crash. Imagine choosing between 2 options. Portfolio A has a higher expected return, but man, it is extremely volatile. In 1 year, it drops 35%. You panic, log into your account, and just sell everything to stop the bleeding. Now look at Portfolio B. It has a slightly lower expected return, but the ride is so much smoother. When the market falls, it's a much smaller, manageable drop. You don't panic, you stay invested, you keep adding to it, and the compounding continues. So which portfolio was actually better? On a spreadsheet, maybe Portfolio A. But in real life, Portfolio B wins every single time. Because a theoretically perfect portfolio is entirely useless if you can't actually stick with it when things get rough. And that brings us to a pretty harsh truth about human psychology. It is incredibly easy to confidently claim you have a quote-unquote high risk tolerance when the markets are green and everyone is making money. That's just theoretical math, but the realistic emotional reaction of logging into your app on a random Tuesday morning and watching thousands of your hard-earned dollars just disappear, that is entirely different. That induces pure panic. Acknowledging this huge gap between theoretical risk and your actual emotional reality is exactly why having a long-term perspective is so essential. It keeps you grounded. It's the only way to ensure you don't panic sell at the absolute bottom of the market. Section 4, the simple framework. Let's make this actionable. It really all boils down to this super straightforward 3-bucket rule. Just think of your money living in 3 distinct buckets. Bucket 1, protect your short-term cash. If you need it in the next couple of years, prioritize stability above all else. Bucket 2, balance your medium-term money. If you need it in 5 to 10 years, you want a little growth, sure, but you also need to protect that approaching deadline. And finally, bucket 3, grow your long-term money. If you weren't going to touch it for decades, let it ride the market volatility so it can heavily compound over time. Protect, balance, grow. It's that simple. Ultimately, the perfect investment strategy isn't something you find by just hunting for the highest number on a spreadsheet. It's found by looking at 2 specific factors. First, your timeline. That tells you the risk you can logically and mathematically afford to take. Second, your behavior and emotional control. That tells you the risk you can practically handle without losing sleep at night. Your strategy, your true sweet spot, sits in the exact overlap between those 2 things. So, before you rush out to chase the absolute highest return, or before you let market hype push you into some trendy investment you don't fully understand, just stop. Take a breath, ask yourself honestly, what is your real investment horizon? Are we talking 2 years for a house or 30 years for retirement? And honestly, more importantly, what will you actually do when the market inevitably turns red? Answer those questions today, and I promise you, your wealth building journey is practically set on autopilot.